Hey everyone, and welcome back to the podcast. I'm really excited about today's episode because we're diving into one of the most fascinating and secretive industries in the world, high-frequency trading. Our guest today is Alex. He began his career as a quantitative crypto trader at Flow Traders in 2020, just before the crypto winter of 2022. He later joined Tower Research, one of the world's leading high-frequency trading firms. Today, he's building QEX, a next-generation financial exchange backed by Y Combinator. We'll talk about what it's really like working inside elite trading firms, why people who earn millions still don't retire, and what the future of financial markets might look like. Alex, thanks so much for joining me.
Thanks for having me. Jessica, I'm excited to be here.
You've worked at two of the world's top high-frequency trading firms. What's it actually like working inside one of those companies?
If I had to describe it in one word, I'd say intense. You're surrounded by some of the smartest people in the world. I'm talking about international mathematical Olympiad medalists, professional poker players, elite engineers. Whatever the typical profile is for the particular firm you're working at. And you're operating in an incredibly competitive business. This isn't like building a B2B SaaS company where everyone benefits by growing the overall market. In proprietary trading, every dollar you make comes from someone else's loss, and the people on the other side are just as intelligent and just as motivated as you are. That's the environment you walk into every single day. Interestingly, during interviews, many firms present themselves as very friendly and collaborative. And to be fair, most people are genuinely respectful. But the people who truly succeed always seem to have something extra. They have an edge. They genuinely want to win. That doesn't necessarily mean they're loud or aggressive. They don't all fit the stereotype of a Chicago pit trader or a professional poker player, although some certainly do. Others are quiet mathematicians from MIT or Cambridge, like me, I suppose. The personalities are different, but everyone is incredibly driven. It's a very results-oriented environment. There's very little room for mistakes. Depending on the strategies your firm runs, the work itself can look quite different. Some firms focus heavily on research, where you're constantly improving models instead of making split-second decisions. Other firms require fast decision-making throughout the trading day. But regardless of the strategy, mistakes are expensive. And unlike many other industries, you don't have to wait months to discover them. You'll often know within seconds exactly how much a mistake costs.
You mentioned that the people who thrive at these firms all seem to have a certain edge. If you had to define what that edge is, what would you say?
I think it's much deeper than simply wanting to make a lot of money. That's what people on the outside usually notice first, because the salaries are incredibly high, especially for graduates entering the industry. Even after just a few years, someone performing at an average level can earn an income that most people would consider extraordinary. But that's not what separates the people who truly succeed. The people who build lasting careers in this industry aren't driven primarily by money. They're driven by competition. They genuinely want to outperform other people who are just as intelligent as they are. That desire to win becomes stronger than the desire to make money. If you look at people like Alex Jerko or Ken Griffin, they've already made billions of dollars. They could retire tomorrow and never think about money again. Yet they continue competing. They continue debating market structure. They continue trying to outperform people they consider their equals. That competitive instinct becomes part of who they are. At some point, it goes beyond money. It even goes beyond rationality. If you perform well in this industry, after 5, 6, or 7 years, it's entirely possible to have earned enough money that you never really need to work again. I have friends from Cambridge who've earned more than $5 million a year for several years in a row. Financially, they don't need to keep working. Yet almost none of them retire. Why? Because everyone who reaches that level shares the same desire to compete. Winning itself becomes the motivation. It's no longer just about money or lifestyle. It's about proving that you can beat other incredibly smart people.
I completely agree with that. When you look at people like Ken Griffin, Steve Cohen, or Jeff Yass, they're worth tens of billions of dollars. That's enough wealth for multiple generations of their families to live incredibly comfortable lives. Clearly, they aren't still working because they need more money. They're still playing the game because they genuinely love competing. That makes me curious about the actual work itself. Trading is such a broad field. There's market making. There's volatility trading. There's quantitative research. There are systematic strategies. There are directional trades. What does the work actually look like inside a top firm like Tower Research?
That's a really great question. When I first entered the industry, almost nobody asked questions like that because quantitative trading was incredibly secretive. Most people assumed firms like Jane Street, Tower Research, Citadel Securities, and Jump Trading were all basically doing the same thing. In reality, they're very different businesses. I usually think about the industry across two dimensions. The first is the time horizon of the trading strategies. When people hear the phrase proprietary trading, they immediately think about high-frequency trading. That means operating over extremely short time horizons. You're trying to predict where a market will move over the next second, maybe the next 5 seconds, or perhaps the next 30 seconds. You're generally not trying to predict where a stock will trade next year. Instead, you're modeling market microstructure. You're analyzing order books, order flow, and tiny changes in supply and demand to estimate very short-term price movements. These strategies usually have limited capacity. Even if a strategy produces outstanding returns, you can't simply keep adding more capital because the opportunity eventually disappears. That's one of the reasons many proprietary trading firms trade only their own money instead of managing outside investors' capital. A high-frequency strategy might only support a relatively small amount of capital, but it can generate extremely high returns on that capital. Historically, quantitative firms focused heavily on these short-term strategies because they're much easier to model mathematically. Predicting what might happen over the next second is often much easier than predicting where a company will trade a year from now. Long-term investing requires understanding business fundamentals, industries, macroeconomics, and many other variables that are far more difficult to model.
That's really interesting because most people assume all quantitative trading firms operate the same way. So, if the first distinction is the time horizon of the strategies, what's the second?
The second way I like to think about these firms is based on their philosophy. Broadly speaking, there are two different schools of quantitative trading. The first is what I'd call the Chicago school. The second is the mathematical or scientific school. The Chicago firms grew out of the old trading pits. Originally, these traders were market makers. Their job was simple: buy low, sell high, and provide liquidity. When exchanges introduced electronic trading and APIs, many of those traders built firms that automated the same strategies using computers. Companies like Optiver, Jane Street, and Susquehanna still reflect a lot of that original culture. The people they hire are incredibly quick thinkers. They're excellent under pressure, highly skilled in probability and game theory, and very comfortable making fast decisions with incomplete information. That style of trading works particularly well in products like options and volatility, where human intuition still matters. On the other side, you have firms like Tower Research, Jump Trading, HRT, and Citadel Securities. These companies were largely founded by mathematicians and computer scientists. They approach financial markets almost like scientific research problems. Everything is data-driven, systematic, and heavily automated. Their goal is to build trading models that continuously improve over time and execute with as little human intervention as possible. This approach works especially well in highly liquid markets where enormous amounts of data are available every single day. Think about products like S&P 500 futures, SPY, QQQ, and other extremely liquid instruments that trade hundreds of billions of dollars daily. In markets like those, it's incredibly difficult for humans to maintain an edge manually, so machine learning and statistical models become much more effective.
So your day-to-day work really depends on which type of firm you're working for.
Exactly. If you're at a company like Jane Street or Optiver, you'll spend a lot of your time solving unique market puzzles, thinking through pricing problems, and making trading decisions. You probably won't spend every day building advanced machine learning models. If you're at firms like Tower Research or HRT, your work is much more research-oriented. You're constantly improving predictive models, training machine learning systems, refining statistical signals, and testing new ideas. Interestingly, many people at those firms don't even pay much attention to the broader market itself. You could walk into HRT and ask someone where the S&P 500 is trading, and they genuinely might not know because their entire focus is on improving their models. By contrast, if you walked into Jane Street, almost everyone would probably know exactly what the market was doing at that moment. That's one of the biggest cultural differences between these firms.
One thing I've always wondered is this. If you look at a typical proprietary trading firm, how much of the business is traditional market making versus taking directional positions or expressing a view on where prices are headed?
That's a great question. The reality is that market making and directional trading aren't completely separate categories. They're really part of the same spectrum. At one end, you have pure market making. In that model, your goal is to stay as close to market neutral as possible. You're continuously buying and selling while trying to capture the bid-ask spread with minimal risk. For example, if I'm bidding for one share of Tesla and my order gets filled, I'll immediately place an offer to sell it back in the market. That's an extremely low-risk strategy. Now imagine your predictive models become stronger. Instead of remaining perfectly neutral, you might decide you're comfortable holding a slightly larger long position because your model suggests Tesla is more likely to move higher. You're still providing liquidity because you're placing passive orders, but at the same time, you're expressing a market view based on your predictive signals. That's where the distinction begins to blur. Today, very few firms operate as pure market makers without any predictive component. Almost every successful firm combines market making with some level of alpha generation or forecasting. That's really where modern electronic trading has evolved.
That actually makes a lot of sense. Another question that comes to mind is this. Many of these proprietary trading firms have incredible reputations. They consistently generate strong returns. They're staffed by some of the smartest people in finance, and they have outstanding track records. So why don't more of them raise outside capital and build hedge funds alongside their proprietary businesses? It almost feels like free revenue.
That's actually a very logical question, and many firms are already moving in that direction. Tower Research, for example, has publicly discussed raising outside capital. Citadel is another great example. They have Citadel, the hedge fund that manages outside investors' money, and Citadel Securities, which focuses primarily on market making using internal capital. Two Sigma has a similar structure. The challenge is that high-frequency strategies don't scale particularly well. The infrastructure, research pipeline, and models are all optimized for extremely short-term opportunities. Those strategies can generate exceptional returns, but they simply can't absorb unlimited amounts of capital. Imagine you have a market-making strategy trading futures contracts. Even if it's highly profitable, the maximum position it can comfortably hold might only be around $1 million. There's only so much capital you can deploy before the opportunity disappears. If you want to manage tens of billions of dollars, you need completely different strategies with much longer investment horizons. That's why moving from proprietary trading into asset management is almost like building an entirely different business. The technology, research methods, and even the way you think about markets are fundamentally different.
That's fascinating. It really highlights how different those businesses are beneath the surface, even though from the outside they all seem to be doing the same thing. Exactly. From the outside, they all look like trading firms. But internally, they're solving very different problems, using very different approaches, and optimizing for completely different objectives. That's what makes the industry so interesting.